Yeah, for anyone who knows the business real well, if you told them, yeah, you could buy the deal for 75,000 per unit, the rents are 1,200, and if you only put in $5,000 per unit, you can actually pop rents $250. Literally, no one needs to know anything more about the deal. They're buying it.
Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larsen. If you haven't yet, get a copy of our book for free at our website, nextlevelincome.com. That's www.nextlevelincome.com. Just click on the book link, and I'll even send you a copy if you put your address in. On today's show, we welcome back Rob Beardsley. Rob founded Lone Star Capital in 2018 and has overseen the acquisition, financing, and management of over $750 million in apartment communities. As CEO, Rob drives the strategic growth of the firm while also identifying and raising capital for new investment opportunities. He leads Lone Star Capital's in-house property and construction management division, Lone Star Communities, ensuring excellence in renovation, lease up, and ongoing management. Rob has sold over 25,000 copies of his 2 books on commercial real estate, and he's been on the show talking about those books in the past. And today, he's going to share an update on the multifamily market and what he thinks of some of the issues that we're seeing in the market today. Rob, welcome back to the show.
And it's great to be here with you.
Yeah, it's always good to see you. Always looking fantastic. They're up in the World Trade Center, which we've been to a great event that you hosted up there not too recently. My family's even been up there to check out your operation when we were coming through New York a couple years ago. Very highlight of our trip. Took us to what was it? The best burger in the country?
Well, it was rated best burger in the country, but I actually like the wings there, but
Yeah,
still, it's all good.
the wings are really good too. Yeah. Yeah, fantastic. And Rob, I'm excited to have you on today because we're going to do a multifamily update. We're going to talk about the market. It's been very dynamic, up and down here over the past couple of years. Also want to share an update on, not only in the multifamily market, what you guys are seeing at Lone Star, and also what really is working in the market. And I know you've been on the show a couple times here in the past, but if you don't mind, for any listeners that haven't seen you or heard you before, give a little update on you, your background, and Lone Star.
Sure, that sounds great. Yeah, I'm the founder of Lone Star Capital. We've been in business for 7 years now, acquiring and operating multifamily, essentially 100% in Texas. So we've purchased 750 million in assets. We're vertically integrated, so we operate all of our deals in-house, construction management and property management, and we, raise capital across the spectrum from high net worth individuals, family offices, smaller funds, and so on.
Yeah. And Rob, one of the things that we really like, and one of the reasons that we partner with you, for those listening that aren't aware of that, is because of that integration. We were just doing a session, as a matter of fact, last night with our coaching, our private coaching group, and you were going through your underwriting model and some of the things that you've seen and how you've been able to kind of fine tune those. And that was I think it was very eye opening for a lot of our coaching clients to see that, and it really shows the value. Have you guys always been vertically integrated?
Well, we kind of vertically integrated as
Yeah.
early as possible, right? And
Yeah.
so that's a big challenge with vertical integration is scale, right? It's really
Yeah.
hard to just open your doors and say, okay, well, we're vertically integrated and we have an HR department, we have a construction department, we have a regional maintenance supervisor, we have regional managers, director of operations, right?
Yeah.
I mean, it's such a people-intensive business. So we vertically integrated, I would say, earlier than what's conventional, but still, we definitely started out third-party management, and then over about 3 years, it took us the time and scale to build up a portfolio and the expertise and kind of the relationships to actually bring operations in-house.
Yeah, and one of the things I've noticed, Rob, in working with you is that, specifically over the past few years, as we've seen, cap rates expand in a lot of markets. Rents have been flat in a lot of markets. Having a really tight grip on operations and being able to fine tune those dollars has really made a big difference. What have you seen on that front?
Yeah, this is really the story of the last few years because truly running till the interest rate changes and kind of the whole economy changing,
Yeah.
you didn't really make money from operations. And I'm
Yeah.
being, slightly facetious or I'm
Yeah.
exaggerating things, but essentially, if you bought property and you didn't matter really what you did with it, you could
Yeah.
renovate it, you could not
Yeah.
renovate it, you could manage it well, you could mismanage it, almost didn't really matter. What
Yeah.
almost mattered more was how much leverage you put on it, and how kind of cheap or give a deal you're able to buy because
Yeah.
that did the best. And
Yeah.
so it was almost like, who cares about anything? Just buy the riskiest deal and you would make the most money. And so we're in a completely different environment
Yeah.
where you're actually rewarded for your hard work. We're kind of back to get rich slow in real
Yeah.
estate, which is how real estate has always been and how it should be, right? It
Yeah.
shouldn't be like this cryptocurrency get rich overnight thing, right? Real estate's low, long and slow. And that's great. And you're totally right. It's really forced us to get back to the basics and grind for every dollar. And so we've just been focusing a ton on operations. We've been, I'd say, compared to a lot of groups, we've been pretty active during this time because we've been fortunate enough to be in a strong position to play offense rather than defense. But with that being said, we haven't been that busy. I mean, we haven't bought a deal in over a quarter. We've been busy like crazy because we've just been investing so much in our operations.
Yeah, and I'll kind of toot your horn a little bit here, Rob. Last time I saw you, you're basically pulling an Elon Musk man, sleeping in one of the spare apartments in one of the properties down there, and really spending a lot of time on the ground, making sure that your operations team was all over it. And you guys have a heavy focus, Lone Star Capital focused on the Lone Star state of Texas. Talk a little bit about one, the markets that you guys are in and why you've chosen those, and also two, the types of assets that you guys are buying and how that may have evolved here over the past few years.
Yeah, so true to the name Lone Star Capital, we focus on essentially all the major markets in Texas, kind of minus Austin. Austin has been a bit of a growth market for us that we didn't want to go and chase and compete in that growth market. But if you look at Dallas, Houston, and San Antonio, those are still very big markets, very strong markets, some of the best markets in the country. And so what
Yeah.
we've observed over the last while in those cities is a lot of supply. And that's not unique to those cities. That's happening across the country, in particular in the Sun Belt, where a lot of development activity was focused on because where there was growth, where there were attractive headlines for jobs and migration and so on, developers went there and built a lot as well.
Yeah.
So you're seeing a lot of supply. However, Houston has the least amount of supply of all the major markets in Texas. And actually, of the major markets around the country, Houston's actually relatively good shape, which is amazing. We didn't really predict it. Uh, Houston being our major market where we own the most assets, it's really benefiting us tremendously because we saw the least amount of drop off as far as negative rent growth or
Yeah.
concessions, vacancy, and things like that. Whereas Dallas and San Antonio are struggling a bit more.
Yeah, and I mean, going back just one step there, Austin. I mean, I remember 10 years ago, Austin was crazy. We were seeing cap rates get down into the, fours, and then they went down into the threes, and then supply really dialed up. And now we've seen Austin be one of the markets where rents have actually gone down the most, and also housing prices have gone down the most. So it seems like your patience in that market specifically has been rewarded. Houston, I've been a big fan. Actually, one of my first multifamily deals I ever invested in as an LP was in Houston, and is actually one of my worst deals I've ever been in because the hurricane came through in 2015, ripped the roof off of one of the buildings. We had some management issues down there. It was a kind of a problem in a lot of ways. And Houston has always been known as a real energy center of the country. Talk about how Houston has transformed its demographic base and job base over the last 10 years.
Yeah, well, I think that shift has been happening for longer than 10 years, but definitely there's continuous investment in diversifying the
Yeah,
economy. It's one of the largest cities in the country and it's
yeah,
growing. And so it's pretty phenomenal that Houston over the last 20 years has been growing its population at over double the national average. And it is the fourth largest city in the country, right? So
yeah,
it's one thing for a small city to have a fast growth rate, right? But
yeah,
Houston its MSA is, I want to say, almost triple the size of Austin. So this is a massive
yeah,
city with massive growth, right? So you've got sheer numbers and percentages working in your favor. And the city has been, like I said, working hard to recruit Fortune 500 companies, not just in the oil and gas sector, but outside of it too. You've got a
yeah,
medical, you've got education, and there's a ton of stuff happening with the ports and with kind of more like downstream energy stuff. So I don't think
yeah,
it's such a scary thing, Houston, to be the energy capital of the world, because it's not like a boom bust. I mean, I don't want to say it's not a boom bust town. I mean, it has historically been, but correlation to oil prices has
Yeah.
definitely dwindled a lot, and the
Yeah.
technology and things like that, the reliance on specifically oil prices is not as much. People who are working with petrochemical and things like that, they can make money with lower oil prices, not just higher oil prices. So that's a big feature. And then to your point about your first investment in Houston, I think unfortunately, a lot of people have had those negative experiences in Houston, whether they're investing in a tougher demographic or neighborhood or
Yeah.
just weather issues. And so that's kind of one of the reasons why Houston ended up being not as overbuilt as other markets, because when developers were thinking, do I want to build a deal in Austin or do I want to build a deal in Houston? Right? They would go to
Yeah.
Austin because they would think, Houston might be harder to raise money for it, or
Yeah.
we might have weather issues or what have you. So it kind of got overlooked, which now has created a better supply and demand, which is benefiting. But you still have to, of course, be wary of the weather risk.
Yeah, and talking about the energy, I mean, we saw spot oil prices go negative a few years back, and it didn't really it had a little blip on Houston's radar. Whereas 10 years ago, when oil prices dropped from I think they were like 120 back then into like the 50s, it had a massive impact on the economy there. But yeah, the growth in medical, the schools down there. It's really been impressive, and it's one of my favorite places to go. Food's phenomenal. I know we shared some meals and some different recommendations down there. It's really grown in a lot of ways, in very positive ways, and it's predicted to be bigger than LA in the next is it by 2030? You can correct me on that if I'm wrong.
Well, it's got to leapfrog Chicago, but I'm sure
Yeah.
that both of those cities aren't doing themselves too many favors.
Yeah. I know Chicago, LA's California's losing, I think, the most population of any state in the country. We'll see if they get back on track. Illinois has got some issues, and it's tough. It's like, would I rather be in Chicago getting hammered by snow and wind, or would I rather, go in the AC in the middle of summer in Houston? I think a lot of people are realizing that places like Houston, Austin, Atlanta, have a lot of benefits, and they don't have those drags that they have on it, like some of these states that maybe not as fiscally responsible as places like Texas. You mentioned the weather. Touch on that, Rob. Like you said, the weather risk. I know people are probably understanding that, but you can have some storms come through there. There's been flooding in the past. How do you mitigate those risks as you look at opportunities in Houston?
Yeah, well, certainly we can't control the weather, but we can definitely control where we buy.
Maybe,
Maybe,
I don't know.
maybe. But we can definitely control where we own our property and obviously the types of insurances that we buy.
Yeah,
And that I think has served us well. Hurricane Beryl came through last July in
yeah,
Houston, and certain areas were of course hurt more significantly than others. Our portfolio was in better shape. We do have a couple deals that are more coastal, which unfortunately took more damage than some other properties which were virtually unscathed. So it's learning lessons, and it's kind of where we want to own, where we want to be. So you have like hurricanes and flooding and kind of harsh weather risks that. But you also have other weather risks throughout Texas. When you get kind of more north and west, things get colder and you have more hail.
yeah,
And so hail can be very forgiving to your roofs. And so insurance companies have gotten wise to that. And it used to be that you'd be able to have a hailstorm come in, hit your roof, you'd be able to make an insurance claim, a small deductible, and get new roofs. And now the deductibles are so high on hailstorms, you pretty much are not covered for hail damage. And so it's a kind of another thing to be battling. So it's not just it's not just fighting insurance costs rising, you also are fighting less coverage in general. So there's all these things to stay up to date on and kind of fight for not just the best insurance price, but also the best coverage and positioning yourself well with the type of property that you own. So us that results in wanting to own in Houston in particular, kind of more towards the north and the west, getting away from
hmm
the coast,
hmm
and then just higher quality properties, preferably built in the 90s or newer.
Yeah, and we were talking about that last night on that same call. But whether you're in Florida or California or anywhere up the coast where a lot of population has moved, these insurance risks seem to be or insurance concerns seem to be pervasive across all those areas. And I think if you're an investor and you're looking at an area, you just have to understand that and make sure that the operator that you're working with has accounted for that, understands it, and has good relationships as you guys do with your insurance companies to make sure that you're not only adequately covered, but also are assessing, the portfolio as a whole and potentially getting some additional economic, benefit from that. Rob, the other thing, that pops up, a lot of people, with the big immigration push from the new Trump administration coming in, or a new administration coming in, but Trump's not technically new, is people are concerned, like, is this push, this tamping down of immigration going to have a big effect on areas like Texas? What are you seeing? What concerns do you have when it comes to demographics in areas like Houston specifically?
Yeah, well, so kind of first of all, I'm not concerned about deportations. I think that's more of like a headline and a fear-based thing than a
Yeah.
reality because the sheer quantity of deportations that would have to occur would have to be really substantial to make a difference. And I don't think that the government has the political willpower or political will
Yeah.
or the means really to execute on that. So I don't think deportations are a real issue, but it is definitely a fear. I mean, we have property that is in Houston and it kind of fits that demographic and people are genuinely scared and they don't want
Yeah.
to, leave their apartment
Mm.
and or go outside work so because they're scared of ICE. And so that's
Yeah.
I think a short-term issue, but obviously if people are holed up in their apartments scared about ICE, they can't go to work and then they can't pay their rent.
Yeah.
I think we're working through some very minor kind of like anecdotal issues there,
Yeah.
but on the whole, I think basically over the last 10 years, we've had so much immigration, legal and illegal. I
Yeah.
don't think I think for sure the door has been maybe closed a bit. And so we're not going to see the same rate of immigration as the last 10 years. But I think that the data probably that we have today underreports the real numbers that happened over the last 10 years. So
Yeah.
there's, maybe that kind of balances things out.
Yeah, that's a good point. I think we really don't have a firm grasp on the number. I just saw something a week ago. It talked about that we may be underreporting the number of people on the planet by a large amount. So if we can't even figure that out, then I know it's hard to figure out how many people have been coming across the borders. I think a bigger concern, and I'd love to hear your thoughts on this or push back on it, is if you don't have the ability to supply cheaper labor for construction, for instance, it's going to drive potentially labor costs up, new construction costs up. I think it's going to have an effect where it's going to push down supply potentially even further and costs up higher, which would be a benefit for those that own properties already, but also those that are, in the markets as we are, which are, already built properties that are more like a value add 90s, early aughts built properties. What are your thoughts on that?
Yeah, I'm not an economist, but there's a lot going on right now that is
Yeah.
very interesting. And so the
Yeah.
tariffs that are being proposed and supposed to go into effect tomorrow, right?
Yeah.
Uh,
That's right. Yeah, we're recording April 1st. No joke. No joke. Um, and yeah, April 2nd is when the tariffs are supposed to go into effect here, just a few weeks before this airs.
so it's actually, what's happening over these last few days in anticipation of these tariffs is really quite interesting because when you hear the word tariff, a lot of people have been equating that to inflation, right? Oh, well, the government's going to make the costs of things go up, therefore that's inflationary, right?
Mm.
And that's not necessarily true, right? Economics is the imperfect science, right? And so tariffs could actually result in actually decreased demand because, like you said, the
Mm.
cost of things might go up as an example for tariffs, or maybe labor is going to go up because of lack of availability due to curbing immigration or something like that, right? That doesn't necessarily mean the costs of inputs have to go up. It could just mean that people are going to demand less of those goods because they cost
Mm.
more. And so it doesn't actually have a net effect higher on prices, but it could actually have a net negative effect on GDP or basically productivity output. And so I think the market's now starting to kind of take that position because while there's been a lot of saber rattling about inflation kind of coming back, and it even has been showing itself in some of the numbers. that are being reported as
Mm.
far as consumer spending and things like that.
Yeah.
However, the bond markets have been actually trading down rates. So rates actually come down over the last
Yep.
3 days, which is really interesting because
Yeah.
usually rates track inflation, right? Because bond
Yeah.
owners want to be compensated on a real return. They want to have inflation covered plus a little bit of interest on top. So if
Yeah.
inflation is ostensibly higher, then people would think they'd want more interest on their bonds, but we're seeing the exact opposite, which
Yeah.
I think is basically showing the world that, you know what, people don't really buy this inflation tariff thing. They think that we're kind of heading into more of like a slowdown period, like you said, which result in less building, like you said.
Yeah, and that's a great point. We saw rates actually trend up since the election, and we saw the stock market go down, and now we're seeing rates actually reverse course, which yeah, it seems to support that thesis that you have. So yeah, it's a very interesting time when it comes to that, and kind of shifting, on that same course, but shifting to the multifamily side, we've seen a tremendous amount of variability, activity with respect to um, rents, rent growth, cap rates, interest rates. We saw I would call it like a historic storm, if you will, of interest rates as they skyrocketed here a couple years ago. Um, let's start with what effects has that had on the multifamily market, Rob?
Yeah, it's been a big impact, and I think that it's taken years for people to fully recognize, appreciate it, and truly acknowledge it. Because I think a lot of
Yeah,
people were kind of holding out, saying, "Well, everything's okay, everything's going to be
yeah,
fine," and
yeah,
just slowly but surely over time, people have now kind of been kicking the can long enough, and they're starting to realize, you know what, actually things are not fine. And so we're seeing whether you're whether someone was brand spanking new to multifamily in 2020 or 2021, or they were a seasoned, there's issues across the spectrum.
yeah,
And I'm talking people having capital calls to fix what is effectively broken structures where the
yeah.
debt is just way too high for the property. You've got to bring in equity to pay down the debt and just kind of rebalance things.
Hmm.
You have people who have been foreclosed on, and you have people that are selling for a loss. And so this, like I said, it's affecting everyone top to bottom.
Yeah,
And operationally, we touched on this. It's kind of reset the game for longer term holds, really operating well because
yeah,
now buyers are being much more discriminative, or just being more nuanced as far as, okay, hey, why would I buy your deal when this guy's operating the deal better and it's in a better location? They've been keeping it up better
yeah,
shape. So things kind of, I would say, some sense and normalcy are coming back to the market because things did get a little out of whack and too heady.
yeah. Yeah, it was crazy, because when I started, as I was saying, over 10 years ago, the numbers we're seeing today with expected returns and rent growth are back to where they were, kind of that long-term norm, which I think is healthy for the market. I know there's certain market segments that have been hit harder as rents have skyrocketed here. So we're at record high rents in the country and record high housing prices. And we actually rents are still relatively affordable compared to what it costs to buy a house now because rates are so high. How has Lone Star shifted since your founding in terms of the type of assets it goes after? And then we can transition as well into some of the unique strategies that you guys have employed to really take advantage of the affordability issue in this country as well.
Yeah, starting out life, we started many other owner operators in the country in the value add space. So we were
Yeah.
looking at how do we buy mismanaged or underappreciated property that if we put a little love, we operate them better, we renovate them, we can get higher rents, we can get higher income for the property, and then that results in a higher property value. So did a handful of deals in that strategy, and that strategy was really the most popular strategy. It was paying off the best in the times where there was very strong positive rent growth and there was
Mhm.
cap rate compression.
Yeah. And
Then,
just to pause there, if you could buy a property like per unit at say $75,000 a unit or 100, less than $100,000 a unit, and rents were say $1,000 or $1,200, which may seem really low, but that's the type of stuff that we were seeing. And you could inject say 5,000 of capital per unit, and you could raise rents $250. It was a massive payoff, in those properties. but things have shifted as price per units have gone up, cost to build has gone up, and then rent growth has come down, right?
Yeah, no, putting it in numbers like that is
Yeah.
really fascinating because yeah, for anyone who knows the business real well, if you told them, yeah, you could buy the deal for 75,000 per unit, the rents are 1,200, and if you only put in $5,000 per unit, you can actually pop rents $250. Literally, no one needs to know anything more about the deal. They're buying it because that those are
Yeah.
amazing numbers, and
Yeah.
those were available back in
Yeah,
the day.
I got a stack of prospectus in this cabinet over here. Deals all just like that.
So then people were doing those deals, and then those deals they would sell, and then they would sell that deal or a deal similar to it
Yeah,
for 100,000 a unit, and then 125, and then 150. While
yeah,
at the same time, the rents didn't grow that. I mean, they were growing, but not that
yeah,
fast. So now you're
yeah,
talking about buying a 150,000 per unit deal. Rents might be 1,300 or 1,400, and now you have to spend 10 or even 15,000 per unit on the renovations because
yeah,
the competition is higher. The deal down the street put a backsplash in, going to quartz
yeah,
countertops and stainless
yeah.
steel, and so it's kind of a
And
game
costs went
there.
up too. Costs were
Yeah,
going
right.
up
And so
along the
then
way.
just
Yeah,
simply costs went up, and so now you're spending 10, 15,000 on a renovation and only squeezing out $100
yeah.
in your rents. So yeah, that strategy got really compressed. So we started to look around and say, this doesn't have a ton of juice left. So we fortunately were able to find a really great pivot, not necessarily saying that we would never do value add again, but we just found a better strategy for the market that we found ourselves in, which was actually an affordable housing strategy where we were preserving affordable housing by actually not renovating the apartments, but actually not doing anything to them necessarily fancy to raise rents, but actually to lower rents and stabilize the asset.
So say that again. You actually buying property. I know this, but I want the audience to hear. We're buying properties and actually lowering rents.
Yeah, yeah, no, it's
Yeah,
it's amazing strategy
yeah,
because in our opinion, it's lower risk and it's logical, right? Because
yeah,
if you're lowering rents, you're not taking a risk as far as will the market accept these rents and so on. So
yeah.
we're catering to lower income households and therefore restricting the rents. In exchange, we get long-term property tax exemptions. So we're able to kind of do a value add type deal where we're able to get a
Yeah.
pop in our income, but that pop in income doesn't come through increasing revenue. It actually comes through decreasing expenses.
Yeah, and we're talking, I mean, you say lower income. I mean, the deal we were looking at yesterday, rents are about 1,500 bucks a month, on average per unit. So we're not talking about, these class C properties. These are class A deals. The one we were looking at was built in 2004. It looks great. It's got a beautiful pool. The units look wonderful. But and this is one of the things I love about the city of Houston. They're quite innovative in that they're partnering with groups like yours and saying, "Hey, we need more affordable housing. We're going to be innovative. We're going to do things that we can get this affordable housing into the market as quickly as possible." And some of these tax concessions, in turn for the rent concessions, end up making it obviously a great deal for the city and for the residents that are getting those rents, but also it makes it economically feasible for investors like ourselves.
Yeah, it's a great program. It
Yeah,
kind of cuts through the noise, and it's not
yeah,
like a government grant program where you have to do this and that. The money
yeah,
gets all just kind of frittered away, right? This is a
yeah,
direct public benefit for these residents. And then obviously we're incentivized to go do this because we do the tax exemption. So it's kind of it's just a classic, great public-private partnership. And like you said, also affordable housing can look at many different ways.
yeah,
Some people, I feel like their mind goes to kind of like, oh, slumlord, Section 8, and kind of all the negative
yeah,
connotations. But
yeah.
even high quality assets and high quality areas, that's kind of where you need affordable housing the most, right? So
Great
that's
point.
really our strategy
Yeah.
is looking for great areas that actually would benefit from a reduced rent rather than just going somewhere where the rents are already low and kind of catering to
Yeah.
that.
Yeah, and I mean, these are properties like that I lived in when not the exact property, but the same type of property that my wife and I lived in before we were married and owned a home, like in the Northern Virginia market, for instance, like those same type of vintages and different things. And when you look at some of the cost to build a unit of quote unquote affordable housing around the country, I was just looking, San Francisco is spending like 800 grand per unit. Asheville, I think it was like 300,000 a unit. We're looking at somewhere like 175,000 unit, and they're coming onto the market very rapidly. And I like to say, I was just on a panel with there was a gentleman that was doing Section 8, a gentleman that was doing you know um, some more standard house, like single family type housing, and then we compared this strategy, and people were a little confused because they're like, wait, this is affordable, but this looks like a normal apartment, and it makes it very desirable for a lot of people to move into. And it also, the time it takes to bring it into the market is almost instantaneous. So it's a very elegant solution, in my opinion.
Yeah, totally agree. So that we've
Yeah.
been getting a lot of value from that strategy, and we'll hopefully continue to do it so long as the programs exist and we can
Yeah.
find suitable deals for the program.
Yeah.
But also, I think that in the coming years, I think value add will come back into play
Yeah.
as the markets shift and as we see
Yeah.
rents grow again and the dynamics reappear.
Yeah, supply is going down. Everybody seems to be projecting that rent that's going to be buoyant for rent growth to go forward. And as housing continues to be expensive, unless there's a massive housing correction and supply or demand drops off, which we still look at the number of people, quote unquote, living in their parents' basements. There's still really strong household formation, especially in areas like Houston that have great job growth growing forward. And as we wrap up, Rob, if you don't mind, just sharing a little bit about any updates you have with Lone Star this year. I know it's been a little slow. In the past, you mentioned you haven't done any acquisitions this quarter. I know it's been challenging with the debt markets where they are being kind of up and down. What are your kind of predictions? What are your updates for 2025 going forward here?
Yeah, so I mean, the biggest news for us has been bringing on Sam Morris as a partner at the firm. It's been super exciting. We've had a
Yeah.
great working
Sam's a great
relationship.
guy. I know him personally. Yeah, fantastic.
Yeah,
Very
so
excited to hear that.
we've all worked together,
Yeah.
for over like almost 2 years now, and
Yeah.
so he was just such a seamless addition to the team because everyone kind of already worked with him, knew him,
Yeah.
felt comfortable with him, and
Yeah.
he's integrated so well, given that he's a local Houstonian, knows Houston like the back of his hand, knows the rest of Texas well as well, and he provides just another good layer for acquisition, asset management, and of course investor relations because he brings to the team decades of experience and relationships where he's been on the board of multiple banks and he has many investor relationships. So it really just gives us the extra firepower and means to buy the dream assets that we want to add to the portfolio and continue to partner with people like him and his investors and continue to grow.
Yeah. No, again, very excited to see Sam come aboard. I think it's a terrific addition to Lone Star. I was when I got the call from you guys, it put a big smile on my face. And yeah, and the last thing I want to end with, we're going to put this in the show notes here. Rob, share a little bit about the books you have written. I know we've highlighted that. We've shared them with actually our coaching group as well, because you literally wrote the book on underwriting, and we're going to give some free tools to anybody that is listening here that wants to take advantage of that as well.
Yeah, absolutely. So the first book that I published was back in 2020. Like you said, it was about the definitive guide to underwriting multifamily acquisitions. That's a super great step-by-step walkthrough of how we underwrite deals every single day as we continue to target these multifamily strategies. So that book has done incredibly well. We have also made the under model that we use in connection with that process available for download for free on our website. That's been downloaded, I want to say almost 20,000 times now. So I
Awesome.
never knew it would be this, I guess successful, but it's really amazing to be able to kind of share all this knowledge and resources and things like that. And so that inspired me to write the second book, which is called Structuring and Raising Debt and Equity for Real Estate. So this allowed me to kind of really put all my thoughts down as far as deal structures, how to put debt together, what debt to use for what kind of deals, and how to underwrite and model the debt. And then, of course, on the equity side, how to structure the right deal for investors, how to go out and raise that money and just put the best deal together.
Yeah, no, I love it. And if you're interested in that, look in the show notes here. You can get the resources that Rob mentioned, as well as see the two books that he's been on. He's been on the show promoting those as well and sharing a little bit about that. So you can go back and listen to those prior episodes with Rob. Rob, always great to catch up. Always wonderful to have you on here. And thank you for sharing your knowledge and thoughts on where we are in the multifamily market today with our audience.
Yeah, thanks for having me.
Hey, Chris here again. I hope you found this episode valuable. Now, I have one more thing to gift you. We have a page for my coaching clients where you can get a free copy of my book, as well as much more from previous guests on the show. Just check out nextlevelincome.com/coaching to get a free copy of my book, audiobook, and much more. I'll send you a copy of my book and cover all the shipping costs as a thank you for listening to the podcast. Also, please like, share, and take just 90 seconds to give us a rating on Apple Podcasts.